Hey everyone, welcome to the KU Report, another daily editorial. We are chatting with Dana Lyons. Dana is a fund manager and editor of the Lions Share Pro website. We talk with Dana pretty much every 2 weeks to get insights on what his internal market models are telling him about strength, weakness for the broad averages as well as individual sectors. And Dana, we talked a couple weeks ago, beginning of April. A lot has happened since that time. Boy, oh boy, April has been one volatile month. The washout in the markets, post Liberation Day announcements, everything fell, then everything bounced. Again, huge volatility continues to be the major theme. This week, volatility has dropped a little bit, but we are still seeing 1 to 2% moves on the slow days for markets. So, overall, Dana, as you are filtering through all this volatility, and it seems like still a downward bias for these markets. However, again, they have rebounded after that washout. Anything changed in your models? How are you viewing the health of these markets?
Yeah, thanks, Corey. Nothing's really changed in the model. Speaking of the models, it gave us a heads up on this is why we do use the quantitative objective models. They turned lower back in December, well before prices turned lower. So that gave us a great heads up that any more new highs would probably be unsustainable, and certainly those highs in January, February quickly were washed away, and then the tariff news hit and really accelerated the selling. So our models are still negative. It takes a little bit to turn them around, but on major intermediate term, at least bottoms, you do get sometimes you do get some clues ahead of the turn of the model that maybe bottom is certainly in formation. And I think we got that a couple of weeks ago. We got a historic washout in terms of not only prices and momentum, but also sentiment got extremely washed out. And the market data, that especially some of the internal data feeds into our models, got extremely washed out. For example, you saw the new lows on the New York hit up over 2000, which is one of the highest readings of all time. So some of those things, some of those washout type readings give you a heads up that okay, probably the worst is out of the way. Now it does take the bottom's a good low will be a process, so there's probably a little bit more to go after this. Initial reflexive bounce is over. More testing lower, whether or retest at the lows, we'll see, but should get another kind of sell off and then put in a pretty substantial bottom from which we could probably embark on a pretty solid intermediate term rally. Whether or not we go to new highs depends on the averages, but I think that's probably where we're at right now. So staying defensive, especially into resistance levels around that breakdown level from post tariff news. Stay defensive until we get that retest or until we do regain some of those levels and clear some of that resistance. And then you should have time and the ability to get a little bit more aggressive for a decent intermediate term rally.
Well, Dana, in terms of that intermediate term rally, are there things that you'll be watching under the hood to see them improve maybe on a shorter time frame? I know some of these are medium time frame indicators, but things like the sentiment and breadth, looking at the put call ratio, are there any things that you'll see as, hey, this is the signal that the turn is here and time to get more aggressive on the buy side?
Well, certainly an improvement of breadth would be great. It's not always the case that you get a turn in breadth ahead of time, but at least a divergence in terms of momentum indicators, sentiment indicators, so breadth indicators. So if we do get, a retest of those former lows from a couple of weeks ago, if we do so on better breadth readings, if we do so on diverging, meaning higher momentum readings. That's a good heads up that okay, it's not about to get worse. We're probably forming a bottom where we can start, getting a little bit aggressive even ahead of the turn. That's what we'll be looking for. That's what we expect to see, and that's what we'll be looking for. Again, washout type readings we saw a couple weeks ago. You don't see that often, and they've been historically reliable or consistent as pretty good heads up that the worst is over. Another key we'll be watching is the volatility readings like the VIX, like you mentioned. The VIX, the high in volatility should be in. If we see a divergence in the volatility readings like the VIX, when we do test those lows or approach the lows, especially if we do break that down testing, basically if you measure the VIX from the December recent high and you apply some Fibonacci on that, we're basically testing that 61 retracement right now. And we've done a lot of studies on volatility and VIX during panic episodes like we've seen. And once you decisively break that 61 retracement, then historically it's been a reliable all clear sign. So if we do really decisively break down through the 29, 30 level to much lower levels in the VIX, then likely the volatility highs are behind us and probably the low in the market is in.
All right, we are having some technical difficulties here, Dana, but we're just going to run with it here. Hopefully, this does come out okay in the post recording. One thing that I do want to ask you, though, is similarities to when I'm looking at a monthly chart. I do see at least some market or, I guess, candlesticks that are similar to that 2020 volatility. Now, again, very different scenario when COVID was around and the world was shutting down. But the range that I'm seeing on the candlestick just for April here is over 15% on the S&P. We are also seeing a spike in volume. Both of these things very similar to what we saw in 2020. Any similarities that we could draw in terms of trading opportunities to 2020, or is this just a different beast we're living through?
Yeah, I think for the most part, I think it's a different market than we saw in 2020. The COVID market kind of came out of nowhere. There were some late warning signs that helped us get a little bit more defensive. But like I mentioned, we got warning signs this time back in December that something was certainly not something in the market was awry, and at least not head. If you didn't head for the exits, at least get defensive and hedge. And we're seeing a reason of that why over the last couple months. I think in COVID, you saw some of the similarities were in the panic low and then the rebound. And I think what we'll see differently, perhaps this time we might see more of a retest of those lows, or at least more of a bottoming process. In 2020, it was more of a V bottom and right back up to the top, which was more reflective of kind of an exogenous event that the market wasn't really prepared for and really recovered better than it would have had it been more of a market specific event like we're seeing now, where we saw heads up in models back in December. The breath started tailing off, indicating there are some problems in the market like we've seen over the last couple of months. So I do think we see more of a bottoming process as opposed to maybe that V bottom that we saw in COVID.
Well, Dana, another market we'd like to get to is your take on the US dollar. It's down in that 99 level, which has been support in the past. We've seen it go down to the bottom of the range there, but it's also a do or die moment. Some people are saying if this level breaks, we head down into the mid 90s and it could be a free fall. Other people looking for a bounce. How are you looking at the greenback?
Yeah, I'm looking at that 99 level as a key level as well. It did just break. However, it does mark that 61 retracement from the rally we saw from 2020 to the highs in 2022. So I think we have a chance at this being kind of a false breakdown. If we can hold this level and turn around, recapture those recent lows around that 100-ish level, we might be able to put in a false breakdown and get a nice reversal in the dollar. But again, if this 99 level does break down, that would usher in much, much lower prices, I think, or at least the potential for much lower prices. There's not much left on the chart below here.
So in these volatile environments, do you take a more, I guess, defensive stance? Do you have less positions on? Do you open up more positions but trade them more actively? Or is there even an opportunity to take some positions and let them ride, almost ignoring the volatility?
In these panic type environments, you have to be active you either have to be totally out of the market and just ride it out with cash, or if you want to be opportunistic, you have to be actively trading it. So actively hedging, I would say keeping your net long exposure low, or net exposure long or short low, and really actively trade it. We did hold on to a good handful of our long positions through the last, 3, 4 months of volatility, just because we think they're going to be longer term relative strength position. And in that case, we're really focused on hedges and managing risk through adding and covering hedges. And one benefit of that strategy for me personally is then I can focus really in a panic filled high volatility environment. I can really focus on only a couple tickers, whether I'm shorting or covering, as opposed to, a whole portfolio of names where I have to risk manage. Focusing on just the hedge means I can hyper, focus on just one or two tickers in order to manage that exposure. So that's helpful to me in this type of, volatile environment. But as this environment drags on, you do start seeing signs of some areas of the market that have recovered key technical levels and might be setting themselves up for the next stage higher. So this is where you can see where you can get some really advanced warning signs of what might be the next leader in terms of relative strength in that next leg up. So right now we're seeing some good things from some of the defensive names. Utilities back up near all-time highs. Consumer staples have been pretty resilient. Insurance stocks are back up approaching the highs. So there are some pockets of areas that have recovered basically whatever they lost during the sell off and setting themselves up for another leg up. And then overseas, there are a few areas as well, specifically Argentina, which has been a beast for a couple of years, was pretty resilient in the volatility. Now it's back up testing close to its former highs. So these things probably not ready to go yet until this bottoming process has run its course. But once it does, these should break out to new highs early and embark on new highs pretty quickly.
All right, Dana. Thank you very much for taking some time. I know you're on the road right now, but I did want to get your updates in terms of what you're seeing in these volatile markets. Now is definitely a time to stay on top of these markets because, look, there will be some great buying opportunities here. We just need to, I guess, see a little bit more stability in the markets and in a lot of stuff that's going on around the world. But hey, we already did see a bit of a rebound after that sell-off post-Liberation Day. Now the big question is where we go from here and what opportunities lie ahead. We'll be chatting with you in another couple of weeks, Dana. So as always, great chatting with you. And everyone, click that link in the show notes to visit the LionShare Pro website. Dana, thanks for your time. I hope you have a great long weekend.
Appreciate it. Thanks, guys.